October 16th, 2023. I know moves like this look random, but they're really not. You can see bar 8, we tested the bar 8 high. It's exactly what we did to the tick. And why are we testing the bar 8 high? Because limit order traders, limit order bears will sell above bar 8, betting it's a bad stop order entry for the bulls. Why? Because it's a doji bar. So, traders will sell above that thinking that the reversal is going to fail. And it most likely will because this is not a very high probability trade. And when they end up getting trapped, a lot of traders are worried it's a bull trend day. But when you start to see this, you start to realize that it might be some sort of trading range day. And then bulls got another attempt up, which I'll talk about in a little bit. But this was really, really important because this was bulls' attempt to get a second leg up and keep these traders trapped. And when it fails on 46, you can see bulls, all these bulls who are buying here are extremely disappointed and they start to exit longs below this. Why are they exiting longs? Because they know that it's probably a trading range day. And if it's a trading range day, we're going to close this gap and we might have to get back to the 8 high as well. And that's why we got such a climactic bar down on 47 because we're testing this price and we're testing that price. And once you see this, everyone thinks it's going there. And so traders will sell below this, hoping to get a quick move down. That's exactly what happened. Bar 1, good bull bar, closing near its high. But after a big gap up, if you get a good bull bar, I would just rather wait for follow through. If it's going to be a big bull trend day and it's going to start from the open and just get a bunch of bull bars, so you're going to have plenty of bars to get in. I don't think it makes sense to buy above 1. If 2 looks like 1, then great, you can buy above 2 and hope we get more follow through. But I generally, you're going to get disappointing follow through, which is exactly what happened on 2. So bulls who bought above 1 are disappointed in 2. However, you know that those traders are probably going to be able to buy more lower and make money uh, because it's probably a trading range. Follow through for the bears on 3, but the bulls who bought below 2 are probably going to be able to make money. So this really isn't all that good. And you can see bull bar on 4 and 5. What 4 and 5 does, if you look, it's up on 4, down on 4, up on 5. So it's 2 legs up, and it's 2 legs up to the top of a trading range. Basically, any bulls who bought up here were trapped, scaled in lower, and exited during 5. So it's 2 legs up to the top of the trading range. So buying in here really isn't all that good. You notice we're going very sideways at this point, and we have a small opening range. And when you have a small opening range, traders will start to look to just buy the breakouts. Oftentimes, because what will happen is you'll get a bar like 9 where it starts to get big, and sometimes it gets a lot bigger than this. And if you didn't buy the breakout, you're going to end up being forced to buy really high, especially in trading range days. That's really common. Um, 6, this is, I think, just bull selling after the 2-legged correction, and we end up getting a bounce, but bad follow through on 7. Traders who sell above, probably buyers below 6, probably sellers above 6. And 8 goes down and essentially tests 3 close. So traders sold the close of 3, hoping we were going to collapse. We bounced. They were disappointed, and they bought back their shorts around break even during 8, and we got a rally. Some bulls will look at this and say, we got a big bull, we got a big gap, and the gap can be looked at as a bull bar. So you have a big gap and a follow through bar on bar 1, and then you get a 2-legged correction, 2, 3, 6, 7. And they'll look at 8 as essentially a high 2, looking for a second leg from the gap in bar 1, which is a reasonable thing to do. The problem with 8 is it's a doji bar and you're in a tight trading range, so it's lower probability. But it's a good swing trade, especially in the opening range. It's okay to take chances and, because the day's unclear always pretty much on bar 8, so you don't really know how far this can go. So when you start to get bull bars early in the day, especially you get 9, you can buy the breakout. You can buy the breakout above 2. You can buy above 9, any of those. I think 9's a swing trade, though. It's probably reasonable probability, but you're hoping that the bears who shorted the breakout above 2 are going to get trapped. They're disappointed in 9, and you're hoping that we're going to continue to rally and they're going to have to cover, which is, a lot of what was happening here was bears sold above this high, expecting that they were going to pull back and be able to make money. And they were probably disappointed in 11, but we're going to give it one more bar. And then when you get 12, you're extremely disappointed. When you get 11, so they shorted, sorry. And you get follow through on 10, follow through on 11, but the follow through on 11 is really disappointing because it's now multiple bull closes and they were not able to get out. So the traders are probably going to start to cover, and that's why this gets more parabolic. You can see the trend line gets more parabolic, which means it's probably going to end up being a trading range. You can see the bars get bigger too, right? We have the breakup bar and the bars get a little smaller. And if it's a really good bull trend, the bars will generally be a consistent size. But you get this bar with a tail and then a good bull bar and then an even better bull bar. And this was an even bigger bull bar. So the bars were getting bigger, which made it more climactic. But this open gap I thought was extremely important to the bulls. So follow through on 12 and big follow through on 13. Traders starting to take profits up here. I thought there was a lot of resistance up here. This low, trader bulls got trapped. I thought we might find resistance here. This low, bulls got trapped. That's actually pretty much exactly where we went to. And what I mean when I say they got trapped is, traders who bought below here started to scale in. They never had a chance to get out. They just ended up getting killed. And so I thought we'd find maybe some resistance here or here or here. So you have to be a little cautious to be buying up here because you can easily find resistance. Traders do not have to exit below 14 after all these bull bars. The first reversal is probably going to fail. So you can see probably buyers below 14, high of 1, 15, follow through 16. Reversal on 17, but I think you can exit below 17 if you're an always in bull. I think that's a reasonable thing to do. It's a second reversal down. You have probably a pretty good open profit, and how much more is really left to this at this point? You're in the channel phase, so it means you're probably going to start forming a trading range pretty soon. And bulls know that, and so what they'll do is they'll buy the close of 17, hoping that it doesn't trigger. Institutions will buy the close of 17, trying to force it to not trigger. And that's what causes the rally up on 18 is institutions buying, knowing there are bull stops below 17. And we end up getting a breakout to a new high. A decent close for the bulls on 18, but it's 3 pushes up, 1 pullback, 2 pullback, 3. So you have to be wondering, how much higher are we really going to go here? Bad follow through on 19. It's probably okay to exit below 19. And you get an inside bar on 20. It is a bull close, but it's a micro double top and it's 3 pushes up. So again, I would probably be out of longs below 20. And you can see some traders did not exit below 20 and then they see 21. So if you didn't exit below 20, what you were hoping for is if we traded below it, bulls were going to buy it immediately and we continue to rally. And a lot of traders would have exited below here and they'd be trapped out and they'd have to chase the market, which is, also what's happening down here, by the way, is traders are hesitating to buy here, and then we start to rally, and now bulls are trapped out and bears are trapped in. And so bears are covering shorts, buying back their shorts, essentially chasing the market up, driving the market up, and bulls are buying into longs, hoping that that we're going to continue to rally because they weren't able to get in early. And that's why, traders who are buying here, so you'll have a smaller amount of traders buying above 8, but they know that there's probably a 40% chance that you're going to get a big move up, something like this. And with that 40% chance, they know that they can make, let's just use this exact for example. So if you bought above 8, you don't have to exit till here. That's 23 points and you're risking 5.5 points. And so you're getting, 4 to 1, essentially 4.5 to 1. But your probability is maybe only 40% of that happening. Versus if you're buying above 9, well, now your probability is closer to 60%, maybe 50%, probably more like 50%. But your risk is 13 points and you're only making 16 or 17 points. So it's not quite as good as it could be. As far as, that's how the probabilities change as the market moves. Maybe, with 9, sometimes you get an even larger move, but I still think 9 is a swing trade because sometimes you get a bear bar there and the gap closes with 2. The reality is you're risking like 13 points, but you can probably just put a stop below 9. Because if you think about it logically, if you're buying above 9, you really don't want to be long if it gets to below 9. And you're probably going to get out well before that. So while, in theory, the correct stop is down here, the stop here is probably fine. And if you start to get some sort of move down, you're going to get out. So, a lot of traders who are buying above 9 are technically risking, 9 or 13 points, but actually are probably only going to end up losing, 5 points if we start to turn down. So back to here, I think, yeah, that's where I was. So you get 21 and traders who were long, who exited below 20 are causing the selling on 21. And traders who did not exit on 20 are disappointed in 21. If you're disappointed in 21, you're going to try and get back at that 20 low. And that's exactly what happens on 22. You can see the tail of 22 goes up to the 20 low and those traders exit at break even. Or, you could buy here, buy more lower, exit at break even. Or if they had bought lower, they would be exiting with a profit. Doesn't really matter as long as traders are exiting. I think this is all just bull selling. So that's why you get bad follow through on 23. And any trader who sold the close at 22, disappointed 23, exiting around break even during 24, causing the bounce. So none of these are really good buys because this is bears buying back shorts. And none of these are good sells because this is bulls buying, selling out of longs. So this is essentially another leg up, trying to test that 20 low. It's a double top, but I don't think it's all that good of a sell. You might get some follow through sometimes. I think that 26 probably makes the market briefly always in short, but look at this. This is a strong rally. You have to be thinking about the bulls getting a second leg. If you look at a 15-minute chart, you can see how strong this rally was in the beginning of the day. And so when you get strong rallies early, you have to be wondering about if we're going to go sideways and get a second leg up for the bulls. And that's kind of exactly what they tried to do here. This was their attempt at the second leg. I'll get to that in a second, but the tail on 42 is really interesting. I'll explain that in a little bit though. So bad follow through 27 for 26. If you sold 26, you want a big bear bar closing near its low. You want another bar like 26, and you're essentially selling, hoping we're going to get back down here or back here. Probably buyers below 27. You get 28 reversal up. It's a high 2 or a high 3, however you want to look at it. But this is a pretty tight channel, and so we're probably going to go pretty sideways here. You could argue that since it's a wedge, this deserves a second leg, but this also, in my opinion, deserves a second leg. So that's kind of the problem with buying above 28. Bad follow through 29. If you do buy above 28, 29 is not what you want to see. 30 is not what you want to see. So a lot of those traders are exiting, causing 31. 32, so it's 2 legs up, second leg up for the bulls, probably just trying to get back to this low. And then you get 33, a big bear bar. And this is just a tight trading range now, and it's not very good for stop order trading in general. And then 34, bulls on 34 want a big bull bar, undoing what 33 did. And since we've gone more sideways now, this has a little bit less influence. Remember what I say about, corrections should last about half the amount of bars that the trend does. And this, 9 or 10 bars, however you want to look at it. And the correction is about 5, 6 bars. So probably if 34 closes on its high, okay to buy because it undoes what 33 did. But, it doesn't, and it's disappointing. So we start to trade down. And you can see any trader who sold the close at 33 is disappointed in 34. So we get back down here, and those traders are buying back shorts and cause the reversal up on 35. Also, anyone who is, it's logical to buy below 34 too. You're betting that this is going to get a second leg up, and you're in a tight trading range buying low. So it's reasonable to buy below 34 in general. 35, it's a good bull bar. Traders probably, they probably won't buy above, but they might. So this is another one of those lower probability swing trades. I think it's okay to buy above 35 for a swing trade, but I would buy small and look to add on if we start to get consecutive bull bars. This is not a trade where you want to put your entire position sizes in immediately. You can buy above here, look to buy more if we break out, look to buy more on bull closes, really any reason. So follow through on 36, but a tail, and disappointment on 37. A lot of traders, they get 36. It's enough for them to stay long, and they're disappointed in 37. And so you can see 38. It's essentially tests back to the 35 entry price right up here, and those traders sell out of their longs. 39, inside bar, not able to close on its high, so probably not many buyers above. Traders who are front running, disappointed scalping out. 40, not able to close on its low, disappointing. This is just a tight trading range. I wouldn't do anything. 41, same thing, probably buyers. Like I said, on 40, probably buyers below. And 41 is interesting, 42 is interesting. So what it does, any bull who's buying, probably should not have a stop down here. They should have a much wider stop or a much tighter stop, because there's probably support down here. But what some bears will do, some bulls will put a stop down here. It's kind of a mistake because this can happen, but some bulls will put a stop down here, and some bears will put sell stops down here, meaning that the moment we get past this breakout, they'll be short, looking to get to here, hoping that they can make 7, 8 points. And you can see the moment we triggered the breakout on 28, those traders got trapped. There was a 1 tick trap, so they never even had $1 of profit if they sold below here. And what this does is it traps the bulls out, right? So if your stop is down here and you get this big tail and then a reversal up, you're thinking, well, now we're probably going to go my way and I'm trapped out. So that makes a lot of bulls want to buy above here. Additionally, if you're a bear and you sold below here, how do you feel about this? That blows. You don't want to see 42. And a lot of those bears will exit. And so when you have bears exiting above here and bulls that are trapped out, probably looking to buy back their longs above here, you're going to get a big follow through bar like 43. And when you get 43, I think 42 is an okay buy. I think 43 is an okay buy. What are you looking for? What's your premise when you buy 43? Your premise is that we're going to get leg one, pullback, leg two. So you're looking for a second leg up for the bulls. If we're going to get a second leg up for the bulls and the price action is doing this, you want strong follow through. And 44 is disappointing. You wanted a bigger bull bar, and 45 is even more disappointing. Just think about it. If we're going to get a big second leg up, are we really going to get a pullback this soon? Probably not. We're probably going to, usually I think if you're going to get a second leg, you're going to try and race to a new high, and then maybe you'll get a pullback. But a lot of traders, are disappointed that 45 doesn't close strong and think that if we trade below 45, their premise of strong bull trend is no longer valid. Because you think about it, if we trade below 45 and then we start to get a move up, it's too much risk that this is one pullback two and a second leg trap at the top of the trading range. So a lot of traders are worried that if we trade below 45, their premise isn't valid. And so that's why you get traders exiting below 45 and such a big bear bar on 46. Now, when you think about 46, what is it really, right? You have this bull trend line, and then you get a trend line break, and then a lower high. So you have this high and a lower high. So it's a trend line break, lower high, potential major trend reversal. So a lot of traders will sell below 46. But as trading ranges do, the bars often get really big. So 46, it's an always in flip, right? Any bears selling or any bulls buying for any reason here have to get out below 46. Those traders sell, and traders will sell to get short, and we get big follow through back to these magnets. Why these magnets? Because at this point, once you see 46, traders know that the worst case scenario for the bears is probably a trading range day. This isn't going to happen. Most likely, this is not going to happen if it's going to be a bull trend day. Never say never, but very likely that once you get this is not a bull trend day. If it's not a bull trend day, it's either a bear trend day or a trading range day, more likely a trading range day. And so when you get big follow through, that's one of the reasons why you get big follow through is when you get big bars, it's often on trading range days. But everyone knows that we're going to test these magnets if it's a trading range day. So another reason why there's so much follow through on 47. Now I shorted 46 and I scalped out of most of it on the close of 47 because, you get a quick 10 points. Your true risk is zero, right? So you could have had a stop right here above the entry price and you never would have gotten stopped out. So when your true risk is zero and you get a quick, essentially 12 points in what's probably going to be a trading range, it's oftentimes best to just take profits. And I resold a 25% position size below 47. And my premise was that we might collapse. So it's low probability. So that's why I sold a small position size, because it's low probability that 48 is going to just continue to collapse and we're going to get a big bear trend. But basically selling that, I was looking for something like this to happen, right? It's pretty unlikely that that's going to happen. So if you're going to do that, you need to sell a smaller position size. And I did. And then when 48, I was somewhere down here, but when 48 starts to turn up and it starts to turn into a bull bar, traders realize that their premise isn't valid, right? If this is going to be a big bear trend and going to collapse, the bar is going to spend a lot of time near its low, not near its high. There's no reason for the bar to be a bull bar at any point if we're just gonna collapse here. I mean, look over here. This was a bull bar for 2 seconds, bull bar for a little bit. This was never at any point a bull close. This was never at any point a bull close. Sorry. And so you should be expecting that if this is going to collapse, it's not going to get bought up. And so what ends up happening is a lot of traders, once they see the market starting to become a bull bar, they'll just flatten at the market. And that's why 48 gets so big, is because you have bears who are hoping for a collapse, realizing they're wrong and just getting out. And I got out somewhere around the open of the bar. So I took a small loss on this position. But the point is, if you can learn to get out here and take a tiny loss, maybe you take a tiny loss half the time, and small profit, a couple other times, but once or twice, or maybe 2 or 3 times out of 10, this will just collapse and you'll make a windfall profit and you'll make a lot more than you're losing on times like these. So 48, big bull bar. It's a trading range day. So what's the magnet for the bulls? If it's a trading range day, and traders should get out at break even, the 45 low, right? It's where bulls bought. They buy more lower. They should be able to get out at break even because buying below this bull bar was reasonable. It wasn't smart, but it was reasonable because it's a bull bar in a trading range. Bad follow through 49, but never trades below. And you get good follow through for the bulls on 50 and 51. But this bar is a problem because it tells you that's 1, pullback 2. So it's potentially 2 legs up in a trading range. Bad follow through 52. And 53, 54, good for the bulls, but this is just looking like a wedge. Probably buyers below 54, you get 55, tail, 56. Some traders would argue that this is a strong move and then it's two legs sideways and you can buy above 56. But the problem with that is you're buying at the top of the tight trading range, at the top of an overall trading range after three pushes up, so it's not that good. 57, you could argue it's a wedge, but I don't think that's a very good trade because you're selling at the bottom of a tight trading range. I understand that it's the middle of an overall or the top of an overall trading range and it's trading range day. So we might have to test back to the bottom, but 57 is in a tight trading range. And a lot of times you're going to get bad follow through like 58. And that just makes your decision really tough as to what to do. 59, bear bar, but gets bought up. And what's going on 60, right? So on 59, we went down and then up again on 60 and then down on 60. So it's two legs down. So it's two legs down in a trading range day trying to break out of a tight trading range. So is 60 going to work? Probably not. So it's a low probability sell. And when you get 61, that's really disappointing. So a lot of traders looking to scalp out as close to break even as possible. And that's what happens on 62. That's why it doesn't get very far. Additionally, when we haven't quite tested this high yet, and traders who sold above here should be able to scale in and make money. And so if you're selling right here, you're selling right where some other bears are going to be buying back shorts. So it's not surprising we get disappointing follow through. Basically a wedge to 65 or follow through on 66, but probably the top of a trading range. If we're going to get a good by the close finish, it's probably going to start more at like, bar 70, bar 71, maybe bar 72. That's when those usually start. Probably more like bar 72 is when they usually start. But you're probably not going to get that in this situation. 69, some always in bulls might exit below if we trade below, but we see we're not able to on 70. And 71, 72, good for the bulls, and bulls are hoping we're going to break out. But look at the context. 1, 2, 3. It's three pushes up at the top of a trading range. So buying 72 isn't smart. And that's one of the reasons we get a big bear bar on 73. I think 73 is a reasonable sell. You're on the moving average, which is a problem. But it's probably a reasonable sell. But 74 is disappointing. If you're selling 73, you want another bar that looks exactly like 73. And you're hoping we collapse to maybe down here somewhere to test this close. But when you get disappointing follow through on 74, a lot of those traders are buying back shorts, and that's what's causing 75. And if you look, 75 rallied to the 72 low, where bulls bought the low, scaled in, and made money. Basically, and it's too late in the day to take any other trades. For always in, I thought you could buy always in bulls can buy above 8, but it's risky. But it's early in the day, so it's fine. Follow through on 9, good to buy above 9. Clearly always in long, and exit somewhere below 20 or 21. I know I say when you exit, it's usually a reasonable swing in the other direction, but I don't think you want to be selling 21. The bull channel is too strong. Always in bears, maybe you sell below 26, but the problem with selling below 26 is you're setting yourself up for really difficult management because it's very, very likely this is just a trading range. So you have to be super fast to get out. 27 is not good enough follow through. So I wouldn't take that. I think clearly back to always in long on 43. I think 42 is a good buy, but I think 43 is clear. And I think those traders should exit below 46, bears sell below 46. I think that you should try to scalp out as low as possible, but reversal up on 48. Bulls can buy above 48, but the risk is big, so it's not that good. And it probably stayed always in long until 73. Bulls who buy above 48, you're probably going to exit below 57. Maybe bears can sell below 57, but it's not that great. And I think that maybe back to always in long above 65 and then always in short below 73. On the daily chart, it's a good bull bar. It's essentially a high one. We triggered the high one, but above a bear bar. So I wouldn't be surprised if we're trying to set up some sort of double top. I generally think we're going to bounce a little more, but we might have to pull back first. Like I've been saying, I think we might have to get back to this high. But I do think, I think we'll probably end up pulling back, but I also think we're going to end up going a little higher overall before we get like all the way down here or something. So I'm not sure how much higher we're going to go, but I think at least a little bit. on the weekly chart, you can see we got a gap up. We'll probably try to get above last week's high at some point, I would imagine, some point this week. It's starting to get, we're in the middle of the month, so we're pay a little bit of attention to the monthly chart. This is parabolic. But these are still strong closes. So this is enough for a second leg. This is also enough for a second leg, but it did that same thing down. So this goes down and then it comes back up. So it comes back up and then down again. So it's a two-legged correction. And so when you get a two-legged correction, bulls are probably going to get their second leg up here. So I think it's possible we try to test all the way up here to this close. I think it's really dependent on how the end of the month goes. Sometimes bars like this will rally a lot in the last, I say the closing seconds because I'm used to watching the 5-minute chart, but maybe in the closing couple of days, sometimes this will rally a lot and you'll get somewhere up here, but that's relatively unusual, but it's something to remember and be open to. But you could essentially be forming, you got to keep in mind, you have a rally here, right? What did we see today? A lower high major trend reversal. You have a trend, and then you get this, which, breaks the trend line. And then if this turns into some sort of lower high, you can get a lower high major trend reversal, and that could bring us all the way back down to at least here or here, or potentially somewhere down here like this close. But that's getting pretty far ahead of myself. But yeah, that's today.